All right, everybody. It's time to talk some money. Ready to talk about money? I'm gonna turn off my Pink Floyd here. Song appropriately called "Money." But let's get going. We're gonna do a little stock market intro. We're gonna show you how to trade. We're gonna talk about a few technical items, and hopefully, I'm done here not too long. All right, let's roll. So first of all, here we are on our Market Watch Stock Market Challenge, which if you are watching this in the fall of 2020, you hopefully have already enrolled in. You can see that I am only ranked 35th in the class. I believe there's 101 or so participants at this point, about 100 of it. There we go, 101 players. Tony is in first place as of today, made $1,300. Good job, Tony. So you can see I'm actually down a little bit. I've lost $1,300. I'm gonna take a quick look at my portfolio and see what is. And that's as of at 1,300. I believe should be as of the end of the day on Friday. So I don't know where we're at today. Let's take a peek. Looks like I've lost money on Zoom. I have lost money on Apple. I've lost money on Snapchat, although if you can tell, Snapchat is up slightly today, 2.13%. I'm down overall. And then I've lost money on Pinterest. And I've made a little bit of money on Johnson & Johnson and Etsy. I've actually made about 9, almost 10% on Etsy. Now you'll notice these are a little different because instead of saying buy over here, it says short, because I did what was called shorting these, which means it makes money when the market, when the price goes down. So there's a way to make money when prices drop. It's called shorting, you short sale. I will go back and show you that in a little bit here. So I'm not gonna show you quite yet. All right. So this is the stock market watch. Our market watch game, and hopefully you're going to be enjoying this. So I'm going to go back real quick to actually our investing slide. And so I would normally kind of run through this whole thing. We've actually gone through part of this already. I did a prior video that talked about investing terms in the stock market and what the NASDAQ is and the Dow and the S&P 500, and introduced mutual funds. There are a couple more videos on here that can be watched. But for the moment, I'm just going to go through some of these fundamentals. So let me go to present mode here. Let's let you check it out. I'll utilize this pointer. Okay, so there's a couple of key kind of number-driven fundamentals of that stocks will tend to have. And so if you were going to buy shares of stock, you ought to at least look at these. You ought to be aware of what these things are, and possibly utilize these in guiding what you think might be a decent stock. And once again, I am no stock market pro. I do invest in stocks. I've hit some winners. I've had some losers, like every other stock market analysis or analyst. But we're going to talk first about dividends. Okay, so you should know what dividends are. They've been mentioned before in this class, but let's just review it again. So remember, a dividend is an amount that gets paid for every share, and not all stocks pay dividends. Okay, it's kind of like, well, usually pay quarterly, which means every 3 months. Let me go back before I go to yield there. So it's paid per share. It's like you're an owner of the company. You own a share of stock, which means you're a part owner. And as the owner, if the company is making profits, then you want your little chunk of that profit, right? Let's just keep it real simple. If there's 1,000 shares of a company and you own a share, one share, and let's say the company makes $1,000 in profit. This is not a very big company, but let's say they make $1,000 in profit over the course of the year. You might say, hey, they made $1,000. There's 1,000 shares out there total. I own one of those shares. I should get some of that $1,000. So you could argue, hey, if they made $1,000, they should pay out $1,000. And if there's 1,000 shares, then every share should get $1, right? So maybe I deserve $1. However, you also want that company to grow, right? Part of the reason why you invest in companies, you want growth. You want them to become a larger, more profitable company. And so there's going to be you're going to want some reinvestment of those profits. So you maybe don't want them to pay all $1,000 out to the 1,000 shares. Maybe you want them to pay none. Maybe that's just not enough. And not that, by the way, when I say you, not that you have a lot of choice. You're just 1/1000th of the ownership. But maybe ideally the company pays a portion of that profit to shareholders, and then the other portion they reinvest. They buy more equipment. They build more factories. They do more marketing. They do some research. They make their products better so they can even sell more. So some of that profit, is going to be turned back into the company. So maybe they're going to pay, $250 towards shareholders. And so if I own a share and they pay $250 towards the 1,000 shares, I'm going to get not much. I'm going to get like a quarter. I'm going to get 25 cents. Is that right? $2.50. I'd have to do the math, but not a whole lot. But I'd get my little chunk. So corporations pay dividends. They're not talking about $1,000. They're talking about, they make hundreds of millions or billions of dollars potentially in profit, and they're going to kick some of that back to shareholders. So usually more established companies will pay dividends. All right. So longer lasting companies have been around a little while. Maybe their growth has slowed down. Maybe not growing as fast as they were when they were a relatively new company. And so to entice investors, they're going to say, hey, investor, if you own some of our shares, we're going to pay you some money back. You're going to get a little chunk of the profit. Whereas companies like Tesla, companies like Amazon, companies like Netflix, I believe, they don't pay dividends. I own some Snapchat, right? Snapchat, they don't pay dividends. Why? Partly because they haven't been around long enough to have consistent profits, and they are so tech driven. They are constantly kind of reinvesting and reinvesting the company to get that growth. So you don't invest in Tesla in order to get dividend payments. You invest in Tesla because you think they're going to keep on growing. And when they grow, in terms of they get more sales, they earn more revenue, then ideally the stock price goes up. People value that company more, and more buyers are going to buy its stock, and the stock price is going to go up. And now I own shares of Tesla that I originally paid $200 for, and now it's worth $400 because they keep growing. And I'm not worried about getting a little measly, dividend, maybe $1 or $2 on my $200 investment. I'm much more interested in them growing rapidly, and therefore my stock value goes up. So some companies will pay dividends, others won't. Dividends are also called income. So you might hear it called an income stock. Companies that pay dividends provide income for the shareholders. Okay, usually paid every quarter. Sometimes you'll see it just paid an annual dividend just once, but usually it's quarterly, which means every 3 months. Okay, yield. What is yield? Yield relates to dividend. So yield, there's a math term. You got to write this down. If you don't have this, you should write this formula down. You should actually write all this down somewhere if you don't know it, which most you don't. Yield is the dividend per share divided by the price per share times 100%. I don't have the times 100%, times 100%. Maybe I can type it in. I could write it in there. Ready? Times 100. It's hard to do that. Whoop. That makes it a percent. Okay. Times 100%. That's your dividend, or that's your yield. Dividend divided by price. Okay. So in other words, if going back to my Tesla example, if Tesla, let's say I own, a share of Tesla, and they decide they're going to pay $2 per year, $2 per share per year. And if the price of the share is $200, and I own they're going to pay me $2, so 2 divided by 200 would be 1%. It would be 0.01 times 100. Add the percent sign, you get 1%. So I get a 1% yield based on that. If the price then goes up, you'll notice what happens. Well, what happens if Tesla price goes up to $400 a share? I still get $2 per share, but now because the price is higher, my yield gets cut in half and it becomes just 0.5%, half a percent. Okay, so yield you can look at is kind of like the interest rate. So if you've got your money in a bank account and there's an interest rate, right? Right now it's super duper low, like 0.05%, 0.05. Really, really low. It's not good at all. It's practically zero. But nonetheless, that's the interest rate. So you can kind of compare it. You can say, well, I could put $1,000 in the bank and earn 0.05%, or even if the rates got better, earn 0.5% or even 1%. How does that compare if I own a share of stock? Well, if you own a share of stock and the yield on that is 3%, then you're making way better money owning the share of stock than you would be having the money sit in the bank. What's the difference? Well, the difference is if you buy the share of stock, the stock price could go down, right? So going back to Tesla, if I bought $200 of the Tesla and it paid me $2 per share, let's go bigger. Let's go say it pays me $5 a share. Well, that would be 2.5% interest rate. 5 over 200, 2.5%, I believe. And so you'd have 2.5%. But what if the price of Tesla goes down to only $100? You had a bad month. You bought it at 200, and now it's down to 100. It still pays you $2.50 or $5 a share, I guess is what I went with. But now the value you're still lost money because the value of the actual stock. So if you have your money in the bank, it's safe, right? It's not gonna, if you have your $200 in the bank, it's not going to drop down. You're still going to have $200. You're just going to earn a little measly interest, but it's still in a percent. So the yield is a percent. It's similar to an interest rate, but it's based on the stock price. And of course, stock price changes constantly. If you haven't already noticed, it's up, it's down. So if the price goes up, then you're getting the double benefit. You're getting some dividend out of it, and the stock is so-called appreciating. If the price goes down, then it's not as good. You're still getting your dividend payment out of it, but now the value of the actual stock has decreased. Okay, third item here, price earnings ratio. Price earnings ratio. So I know my little gizmos down there. Something called the PE ratio. Now, this is what a lot of stock investors are going to look at. And truthfully, they're going to look at future PE or expected PE, what they think is going to happen down the road. The ratio they usually see is just current PE, current price earnings. So why is this important? Well, let me move this. Price earnings ratio is simply the price per share, the price of the stock, divided by what's called the EPS, or earnings per share. Okay. And this is not a percentage, by the way. This is actually just a ratio. It's actually not even in dollars. So it's price. So if Tesla's $200, there's $200. That's the price. If their earnings is $2 a share, it's 200 divided by 2 is a PE of 100. Okay. That'd be a relatively high PE ratio. Although for a company like Tesla, it might fit the bill. Maybe we'll look it up. We'll look it up in a second here. Okay, so PE. Now, with a trick on PE, I'll go to the next one. Let me erase my 100% here. The trick on PE is, generally speaking, the lower the better. Okay, the lower the better. The historical average, is around 20. It's actually probably closer to 17 or 18. But the going back 100 years, average PE, I'm going to use 20 as the average if you see it, but it may be closer to 18.5 or the current PE average. I'm not sure. Maybe let's see what happens when I click on this. Okay, historical average PE of the S&P 500. So you can see lately it's been higher than 20. 33 this year, 24, 19, 25, going back. You can see in the early teens, it was in the 18s and 17s. And I'm just going to kind of scroll down and you can see a lot of different averages. You can see in 2002 is way up there at 46. That's high. Yeah, somewhere in the teens and low mid 20s. You can see back a while ago, back in the 80s and before, the PE average was closer to 10, 11, 12. Look at those years. And so it's really kind of been the most recent kind of 15, 20-year run that PE ratio has really climbed. So what's driven that? Well, what's probably driven some of that is some of this internet trading, some of the stuff that we're going to be talking about you doing. The ideas of E-Trade, the ideas that the small guy, that you and I can get in and buy stocks, and that increases demand. There's more people trying to chip away and buy stocks, which means that's going to tend to drive prices higher, prices of stocks. And if prices go up, but earnings say relatively are the same, then you're going to get an increased PE, and that ratio is going to go up. Okay. Usually lower the better. Let's kind of show you why. So why? So remember, PE is if a company has PE of 10, what does that mean? That means for every $10 of value, it says invest in the company. But if you were going to say invest in the company, if you were going to buy in, if you're hey, am I going to buy this company as PE of 10? What does that mean? It means for every $10 you're investing, the company earns $1. Okay, so if you invest $1,000, that means the company would earn $100. And of course, if it has a P of 40, that means for every $40 you invest, the company earns $1. So you had to invest 4 times as much money for the same amount of earnings. So, if we were doing like a donut shop, and I said, hey, you give me, here's a little sample down there, I'd like $1,000 you invest in my donut shop. Well, if you invest $1,000, are you going to want $400 back or $100 back? Well, at the top ratio, the PE of 10, you'd be getting about $400 back. You'd be getting 10% of your money back. At a P of 40, you'd only be getting $100 back. That's like 2.5%. It's not as good. So, not that you get it back. I don't want to confuse you that you get the earnings back. Earnings is like the profit the company makes, and they do it on a per share basis. So, like I said, Apple might have over 1 billion shares out there. They do have over 1 billion shares out there. So if they earn $1 billion in profits, it's still just $1 per share, earnings per share. EPS, earnings per share, is another data point you should be aware of. It's earnings. If your company's earnings come out, that's what they're talking about. Okay, so in generally speaking, the lower the better. I think I'm going to get a little sample math problem here. So, for example, I got 3 companies. I got ABC Corp. They've got their share price is $100, and the earnings per share is $2. I got XYZ. Their price is $40. Earnings per share is 50 cents per share. And then we got 123 Corp. Their price is $500 a share, but their earnings is $20. So, if this is the only information that you had, where should you invest your money? Which is most desirable place to put your money? Where are you going to put that? If you have $2,000 you're going to invest, which company is most desirable? Okay. Well, unlike a lot of things, you might just go, oh, it's only $40 a share for XYZ. Look at that, Mr. Huber. That's the cheapest stock we've got, $40. Well, that is the cheapest based off of just pure price. But look at their earnings per share is only 50 cents. So let's calculate PE. Hopefully it shows up. Yes. Okay. So for the ABC Corp, you got to spend $100. They earn $2 a share. So their PE is 100 divided by 2 is 50. Okay. So to spend $2,000 over here, you'd buy 20 shares at $100 each. That'd be $2,000. And then the company, based on that, they would provide $40 worth of earning. They would earn $40 for those 20 shares. Okay, what about XYZ? XYZ, hey, you can buy, first of all, you can buy 50 shares. That's more. That's kind of nice. But their PE is 80. Look at that. That's a high PE of 80. And so by investing in 50 shares, right, 50 times 40 is $2,000, right? We're investing $2,000. The company only earns $25. That's less than the 40. And then 123 Corp, look, $500 share. Wow, Mr. Huber, it's so expensive. But look at their PE. The PE is only 25. You can only buy 4 shares. That's it, just 4 shares. However, with those 4 shares, the company has earned $80. So I'll say once again, if this was a donut company, if this was a little restaurant you were investing in, and you said, hey, we'd like you to invest $2,000, and these were the numbers they gave you, which would you do? Well, you just buy only 4 shares and spend $500 each, because they would earn $80 for that $2,000 that you invested. The worst one would be this cheap one, the XYZ, only $40, and you get 50 whole shares, but they only earn $25 for you. So that's just based on that, it's not desirable. Now, with all that said, a lot of companies with high PE ratios or even no PE, because they might not have earnings, do really well. Why? Because they're new. So a company like Tesla, they've only been making a profit for about a year, I believe. So the first couple of years of Tesla, they had revenue, they had money coming in, they were selling cars, but they weren't making a profit yet. I believe Netflix wasn't making a profit for a long time. I'm not frankly sure if they are. We'd have to look it up. So that would be, so there's no, like, this isn't a foolproof method here. A better method might be expected earnings. Like, and you can look at future earnings. What do you expect earnings to be like next year? What do you expect PE to be next year? And then that gives you a little more of a clue about the value of the company often. All right, I'm going to end that for the moment. I'm going to try and get it done here quick. All right, so I'm going to go back quickly to our profile here. So let's look a company up. I've mentioned Tesla quite a bit. Let's check Tesla out. So I type in, I'm on my market watch. I type in a company search. There's Tesla. I want to check it out. Ooh, it's down to $397, which means it definitely lost some money last week. I could take a peek. How did it do last 5 days? Kind of like looking at graphs. Oh, yeah. It was like Friday, definitely dipped, because it was up to $425 last Monday or so, and it got all the way down to 380 or so. Lost $40 a share, 10% of its value. But it's come back. See, could have bought on Friday, you would have made $10 a share today. All right, so there's a general Tesla quote. Let's go to the full quote, though. Let's see if we can see some of the things we discussed there. Okay, so if you click on that full quote, a couple things. First of all, here's our price, right? $397.33 a share. It's right now. It's bound to change. I'm not positive if this site gives a constant change or not, but that is likely to change. Not by much, but it'll change a little bit. Okay, we can scroll down here, and we can see some of those financials I talked about. Oh gosh, so here's Tesla. PE of 790. That's really high PE. They only earned 50 cents a share. So you're spending $400 on a company that only earns 50 cents every share. That's a super duper high PE. But look at this. If you had invested in Tesla a year ago this time, your investment is up 525%. 525. That's, crazy percent. And last month you've lost 6%. Last 5 days you lost 5%. Last 3 months, however, you're up a third. You're up 33%. Which, once again, if you had your money bank account, you'd be up 0.05. That's horrible. Matter of fact, the last 3 months you'd only be up like 0.125. You'd be up a quarter of 0.05. 0.0125. Shoot, not even that. Okay, so there's some information on Tesla. We can click and go deeper into this if we wanted. If you're scrolling here, we've got our 52-week range. Another 52 weeks of the last year, so it's been as low as almost $2 a share. It's been as high as $500 a share. If you would have bought it around this time last year, you would have paid closer to almost $2 a share, and now it'd be worth $400. It's pretty good, right? It's really good. Let's take a quick peek at another one. Something that's maybe, let's compare. A lot of you have Apple. A lot of you have Apple products. Probably most all of you. Let's take a look at Apple. So I'm going to type in a symbol search and take a little peek. Here's Apple. Lost a little money today. Apple's $107.94 a share. Let's do a little full quote. Let's check it out. What do we got on Apple? Apple's a little different than Tesla. So first of all, Apple's $107, $108 instead of almost $400. You'll see its PE ratio is way lower, 33. It earns $3.27 a share, as opposed to Tesla was earning 50 cents a share. Apple pays a little dividend, 20 cents. Okay, 20 cents. Now that is probably quarterly, 20 cents a quarter, which means 80 cents a year. How do I know that? Because remember, yield, which is over here, 0.76, it's your annual dividend divided by the price. So I know 0.2 divided by 107.83 is not 0.76. However, 80 cents, 0.2 times 4 quarterly, so you can go 4 times a year at 20 cents a share, is closer to 80 over 107 is going to be about 0.76. So this is, when you see dividend, it's this is the quarterly dividend that they pay you. Yield is calculated with annual dividends divided by price. So even though this is not a tremendously high number, you would still be making 0.76% on a stock that's pretty darn valuable and has had a pretty good year. It's not up like Tesla. You can see Apple's up 67%. Going back to last year, it's up about 47% this year. It's only up, it's actually down 1% in the last 3 months, where Tesla was up 33%. So Tesla was a much better investment over the past year, even though they've got a super high P ratio and they don't pay any dividends. Okay, so that would be Tesla. Let me find a more middle of the road, and then we're gonna wrap this up and be done. Okay, maybe we'll even buy one of these. Let's go with Microsoft. Been around a long time, large company, still down today. By the way, I wouldn't get too upset about anything up or down on any given day. So Microsoft is $201 a share. Let's get a full quote. Let's take a little look. How's Microsoft's numbers? You can check it out. So Microsoft, you'll see the PE ratio is very similar, 32.6, as it was Apple's. You can see that their price or their earnings per share is higher. However, remember, their price is higher. Apple's at $107 a share, Microsoft about $102. Apple's earnings was somewhere in the $3 range. They pay higher dividend, and this would be quarterly. So if you, once again, 0.56 times 4 would give you $2.24, and $2.24 divided by 201 is going to get a little more than 1%. So you're going to earn a little over 1% with Microsoft, a little bit better yield, a little bit better dividend, but you can see that they didn't return quite as much. They haven't had quite as good of a year as Apple had, only 40%. So if I were to have the choice, I'd rather have a little bit smaller yield, but have earned 60%, I think was what Apple was a year going back last year. With that said, I'd rather have Tesla. I'd rather earn 500% going back last year and have no dividends. But you never know if Tesla, what was going to happen with that. I'm going to show you one with a relatively high. By the way, we could sort by, look at that. We could sort by least value, most value, ticker symbols. That's my portfolio, I guess. Let's see, one last one. Let's go to Exxon. Let's type in Exib, not Exib. Exxon Mobil. Maybe you want some gas. Gas prices are coming down a little bit. Maybe you want some gas. Let's see about gas. Hey, Exxon's up today. Let's find out. Only $33.82 a share. You can see it's up 3.68 today. That's better than the other three we both look. Actually, no. Tesla was better. We'll go to the full quote. Let's check out Exxon. Let's see what we got. Higher P ratio than Apple and Microsoft, but wow, look at that yield. 10.3%. That is a high yield. So they pay 87 cents per quarter per share. It only costs you $33 to buy a share. And yet they're going to pay you 87 cents a quarter, which is about $3.50 per year per share. So 10% yield. I mean, we talked about if you can average 10% in a given year, that's a great year. And this is going to pay you 10% just in dividend payments, let alone whatever it might gain or lose. Now, with that said, you can see the 52-week range. It's been as high as $73. It's only $33. If you would have bought it a year ago, look at that. You would have lost 53%. You would have lost half your money in Exxon. So, yeah, good news is you're in 10% yield. The bad news is you would have lost half the value of the stock, which means a year ago or so, it was closer to $65, $70 a share, not 33. But maybe it's buy low, sell high. Maybe it's low, right? Maybe you can buy right now, and you can get this great dividend, this great yield, and maybe it's on the low end. If you think oil's going to rebound, if oil's not going away the next decade, and it's going to be valuable, then maybe this is one of your long-term bets. I don't know. That's up to you. There's a lot of ways to look at it. So those are some companies. Hey, what if I wanted to purchase that, Mr. Hubert? How do we make this purchase? So I'll show you quickly, and then I say quickly a lot. This will be the last thing I do here. So I don't want to purchase Exxon for the moment. Let's purchase. Let's go for some Twitter. All right. I don't think Twitter's going anywhere. Who knows? With all this election stuff coming on, maybe it's going to just continue to hit some more. It's going to people love to see that. Ooh, down 4%. Should that scare me? I don't know. 4%'s not a great day when the market's up, but I'm going to go with the buy low, sell high theory. So let's click on it. Here it is, 39.67. Let's take a little look. I like kind of looking at this. What do we got the last month or so? Ooh, look at that. It's kind of falling off a cliff here. It was as high as $50-something back in, the end of October, which is last week. So Twitter has really fallen. But you know what? I'm going to bet that it's not going to keep falling. What do I know? All right, so let's make a trade. So I've got Twitter here. Once again, how many shares do I want? It is, how much is it again? It's about $40 a share. I've got $100,000 I need to eventually spend. I'm going to put about $8,000 in here. 200 shares times $40 is about $8,000. I could also drag this around. Could add my shares in the orange bar there. That'll show you how much of my portfolio it is. I'm going to go with 200 shares. It's a day order. I'm going to do a day order because it's in the trading day. Right now it's 9 o'clock. Market closes at 1 p.m. our time. I'm going to do a market order, and I'm going to buy. Now, remember, I could sell short. If I thought Twitter was going to decrease in value, if I thought it was going to keep going down, I would sell short. As a matter of fact, I kind of do think it's going to keep going down. But I'm going to buy anyway. So selling short means that you're betting that the market's going to go down. I'm not going to get in all the details again, but the deal is when you sell short, if the price decreases, your value goes up. You make money. Whereas if you're buying it, if I buy it, then I need the price to go up for me to make money. Okay, so I'm going to count on the market going up. I've got my 200 shares. There's no commission. Total expect to be about $7,900. If you want to look up sell short, you can look it up. Pretty easy to figure it out. And if it's after hours, if it's in the evening or like after 1 o'clock, I would use good till canceled as opposed to day order. Probably use good till cancel right now if I wanted as well. And you can ignore limits and stops and all that. It's limits and stops are used like if you wanted to max. So if I didn't want to buy at anything greater than $40 exactly, then I could do a limit. But I'm just going to do the market order because it's going to happen right now. You ready? Here I'm submitting. I submit my order. It's been submitted. It's been executed. And drum roll. Let's view my portfolio. And what do we got? Is it in there? Let's see it. Where is it? There it is. Twitter. I own it. 200 shares. I've already made $3. Even though it's down today, It's a little higher already than what it was when I bought it just 20 seconds ago. Okay, that is it. That's how you do it. So that's how you buy. That's the kind of things you can look at. Invest in companies you know. That's my speech. Okay. So enjoy. Do your best to pick your portfolio. Minimum at least 5 companies, no more than half in any one company, and you got to spend at least 90% of your money on stocks. You gotta spend at least $90,000 basically. Okay. So that's it. Peace out. We'll talk to you soon.